News is about a month and a half behind the real numbers. It's actually a little bit worse for what we're seeing. I mean, our days on the market are at record highs, our inventories are record highs, and our closed transactions are at record lows. The only thing that comes next is price drops.
Yeah, and you're seeing that, right?
Yeah, we're right now throughout the state. I mean, there's different local markets, but we're anywhere from 3% to 12% down year over year right now.
Just 2 years ago, Florida was the hottest real estate market in America, with over 314,000 newcomers paying record prices in a pandemic-fueled buying frenzy. But now, the governor is scrambling as that migration has collapsed by 80%, wiping out 250,000 buyers a year and forcing desperate price cuts across the state. Why did deep-pocketed buyers suddenly bolt? And what hidden forces are fueling the exodus? The untold fallout starts here. The population surge that swept through Florida between 2020 and 2022 brought a new kind of resident to the Sunshine State. At the heart of this wave were high-earning professionals and families, many of whom left behind cities like New York, Los Angeles, San Francisco, and Chicago. Census records show that in 2022, Florida gained more than 314,000 domestic migrants, more than any other state in the country. These newcomers weren't just retirees in search of warmer winters. For the first time, remote work allowed white-collar workers to keep their six-figure salaries while living hundreds or even thousands of miles from their company headquarters. Leaving behind high state income taxes and expensive housing, these buyers saw Florida as a financial haven. The absence of a personal income tax, combined with no estate or inheritance taxes, meant that families relocating from states like New York or California could see immediate savings worth tens of thousands of dollars each year. For many, the promise of lower costs, year-round sunshine, and the ability to keep working remotely proved irresistible. The demographic shift was visible in the neighborhoods and suburbs that filled almost overnight. In Miami, Tampa, Orlando, and Naples, realtors fielded calls from buyers who had never set foot in Florida but were ready to make offers above asking price. The influx was especially strong from the Northeast Corridor. New York and New Jersey sent the largest share of new Floridians, followed by California, Illinois, and other high-cost metros. Families, young professionals, and investors all joined the rush, lured by the idea of more space, better weather, and a fresh start. This flood of out-of-state money transformed the housing market. Local incomes couldn't compete with buyers arriving with cash from selling homes in expensive cities or with the financial flexibility of remote tech and finance jobs. Bidding wars became common, and sellers watched as homes sold within days, sometimes sight unseen. Florida's economy, already one of the largest in the world, surged with new arrivals. By 2023, the state's population reached 23 million, and the growth showed no signs of slowing. For a brief moment, it seemed like Florida's open-door policy and fiscal advantages would keep the boom going indefinitely. Bidding wars became a defining feature of Florida's housing market during the migration surge. Homes in Miami, Tampa, and Naples routinely received multiple offers within hours of hitting the market. Realtors reported buyers submitting contracts for $20,000, $50,000, even $100,000 above the listing price, hoping to outflank the competition. In 2021 and 2022, nearly 1 in 3 homes statewide sold for more than the asking price, according to Florida Realtors deal data. The most aggressive buyers often skipped inspections entirely, waiving contingencies that once protected them from hidden repairs or structural problems. For sellers, the offers seemed too good to be true. No financing delays, no haggling over minor defects, just fast, clean closings at record prices. A new term entered the market's vocabulary: sight unseen offer. Out-of-state buyers, flush with cash from selling in New York, California, or Illinois, made offers on homes they had never visited in person. Some relied on video walkthroughs or FaceTime tours with agents. Others simply trusted the address and the neighborhood's reputation, eager to lock in a Florida address before prices climbed higher. In Naples, agents described listings receiving 10 or more offers in a single weekend, with buyers escalating their bids in real time as new offers arrived. Escalation clauses became routine, pledging to outbid any competing offer by several $1,000s up to a set limit. The pressure was so intense that some buyers included personal letters, photos of their families, or even offers to pay sellers moving costs in hopes of standing out. Local buyers, often relying on Florida wages, struggled to keep up. The median household income in Florida hovered around $65,000, but many newcomers arrived with salaries well into six figures, or with cash from homes sold in far pricier markets. This mismatch fueled price growth at a pace the state had never seen. The median home price in Florida jumped from $275,000 in early 2020 to $430,000 by April 2024. In hot markets like Tampa and Orlando, homes listed at $350,000 routinely closed for $400,000 or more, with buyers waiving every possible contingency just to get a foot in the door. The frenzy created a sense of inevitability among sellers and realtors alike. Homes that might have taken months to sell in the past were gone in days. Investors and flippers joined the rush, confident that rising prices would cover any risk. But beneath the excitement, the market's foundation grew increasingly fragile. Prices were set by the most aggressive, deep-pocketed buyers, often those least connected to local economic realities. The bidding war tactics, sight-unseen purchases, and relentless escalation pushed values higher and higher, but also left the market exposed. When the migration wave slowed, the buyer pool shrank, and the same mechanics that had driven prices up would soon begin to work in reverse. In 2023, a wave of corporate memos landed in inboxes across the country. Tech giants like Amazon, Meta, and Google, along with major banks and consulting firms, issued clear instructions: return to the office or risk your job. For thousands of remote workers who had seized the chance to relocate to Florida, the message was unmistakable. The lifestyle that once seemed permanent, sunny mornings, no state income tax, working from a laptop beside the pool, was suddenly on borrowed time. One former Tampa resident, hired remotely by a New York-based fintech during the pandemic, describes the moment her company's policy changed. She had moved her family south in 2021, bought a home site unseen, and adjusted to Florida's rhythms. But in May 2023, her employer's new attendance policy required 3 days a week in Manhattan. The cost of weekly flights, or the prospect of paying rent in two cities, made the Florida experiment impossible. Within weeks, her home was back on the market, one of thousands listed by workers caught between corporate demands and the lives they'd built. The numbers tell the rest of the story. Nationally, the share of remote job postings fell from 21% in early 2022 to just 13% by late 2023, according to LinkedIn and Indeed data. Florida's own Department of Economic Opportunity reported a surge in outbound moves among young professionals and dual-income families, many citing return-to-office mandates as the breaking point. In Miami and Orlando, real estate agents began fielding calls not from eager buyers, but from anxious sellers forced to leave. Major metros felt the impact first. Miami-Dade and Hillsborough counties, which had gained thousands of remote tech and finance workers in 2021 and 2022, saw net outflows by early 2024. IRS, change of address records, and county-level census data confirmed the timing. The steepest migration reversals tracked directly with the rollout of office attendance requirements in the tech, finance, and consulting sectors. The buyer pool that once drove bidding wars shrank almost overnight, leaving a gap that local incomes could not fill. For Florida's housing market, the end of remote work flexibility was not just a policy change. It was the trigger that started the exodus. September 2022 brought devastation to Southwest Florida as Hurricane Ian made landfall, inflicting $112.9 billion in damage and upending life in counties like Lee and Collier. In the months that followed, homeowners across the state began receiving insurance renewal notices that looked nothing like the bills they remembered. Premiums that once cost $2,500 a year now arrived at $10,000, $12,000, even $16,000 for some coastal homes. For one Cape Coral resident, the annual premium jumped from $3,200 to more than $15,000, an increase of nearly 400%. The shock was not limited to a handful of unlucky families. Thousands found themselves forced out of the private insurance market altogether as carriers declared insolvency or pulled out of Florida. By mid-2024, Citizens Property Insurance, the state-run insurer of last resort, counted over 1.4 million policies, a record high. New policies in hard-hit zip codes averaged $13,000 or more, with some homeowners paying mortgage-sized sums just to keep coverage. In Lee, Charlotte, and Sarasota counties, the pattern repeated. Residents whose insurers went bankrupt had no choice but to accept whatever coverage they could find, often at triple or quadruple the previous cost. State filings confirmed that major carriers received approval for rate hikes of 30% to 100% per year, sometimes back-to-back. For those unlucky enough to be forced into Citizens or surplus lines, the cumulative effect was staggering. 400 to 500% increases within 2 years were not uncommon. These are not statistical outliers. They are the lived reality for thousands along the Gulf Coast, especially in flood-prone or older homes. The insurance crisis quickly became a central factor in Florida's migration reversal. New arrivals who had budgeted for sunshine and tax savings found themselves blindsided by bills that rivaled the cost of their mortgages. Stories of retirees draining savings to cover premiums and families abandoning homes they could no longer afford began to circulate through neighborhoods and local news. Insurer exits and insolvencies rippled through the market, leaving even those with spotless claims histories scrambling for basic coverage. For many, the math simply stopped working. The promise of affordable living in Florida turned into a financial trap, forcing hard choices and, for some, an early exit from the state. The aftershocks of Hurricane Ian and the double hurricanes that followed in 2024 did more than damage property. They shattered the economic foundation that had drawn so many to Florida in the first place, making insurance premiums a deciding factor in who stayed and who left. A newcomer to Palm Beach County, lured by the promise of no state income tax and endless sun, found herself staring at a property tax bill that rivaled her old New Jersey payments. The numbers didn't stop there. Her new home came with a mandatory HOA fee, $650 a month, covering pools, landscaping, and security. The expected savings vanished. For those who bought during the 2021 and 2022 price surge, county-level property taxes landed with particular force. Condo owners along the coast faced not only regular dues but also special assessments in the thousands, levied to repair hurricane damage or meet new insurance demands. The cost of living, once the main draw, now felt like a moving target. Summer 2024 stripped away any illusions about Florida's climate. A family from Boston, newly settled in Orlando, endured their first full season of heat. For weeks, the heat index hovered above 100 degrees, humidity pressing in until even a walk to the mailbox felt punishing. Air conditioning ran day and night. By August, 2 hurricanes hit the Gulf Coast in quick succession, sending evacuation routes into gridlock and leaving inland neighborhoods without power for days. The rituals of hurricane season, stocking up on water, tracking forecast cones, became a source of constant anxiety. For many, the weather was no longer just a backdrop, but a daily test of endurance. In Orange County, a planner sifted through Florida Department of Transportation data and saw the strain in hard numbers. Interstate 4, the region's main artery, now carried nearly 150,000 vehicles each day, a 14% jump since 2019. Average morning commutes stretched from 32 to 41 minutes. Some stretches saw 4 hours of congestion daily. School enrollment surged by more than 10,000 students in 3 years, forcing districts to rely on portable classrooms and postpone new buildings. Water utilities and emergency services struggled to keep up, with peak summer usage and EMS calls both up double digits since 2020. The daily reality? Crowded roads, longer waits, and the sense that Florida's infrastructure was buckling under the weight of its own growth. For those who arrived seeking lower costs, better weather, or more space, the trade-offs became impossible to ignore. Hidden expenses, relentless climate, and mounting congestion all shaped the decision to stay or to move on. Florida's housing market once depended on a steady stream of new arrivals, but the numbers now tell a different story. In 2022, net domestic migration brought more than 314,000 people to the state. By 2024, that figure had dropped to just 64,000, a staggering 80% decline. The missing 250,000 people per year aren't just a statistic. They represent families, professionals, and retirees who would have formed households, bought homes, and contributed to the local economy. Census data and county-level records show how quickly the buyer pool evaporated. During the peak, each new arrival often meant a new household, and for every household moving in, realtors counted a likely home purchase. The math is straightforward. In 2022, migration alone supplied enough demand to absorb most new listings and keep inventory tight. With the drop to 64,000 net newcomers, the market lost the equivalent of a mid-sized city's worth of buyers every year. This disappearance is visible across Florida's counties. Metro areas that once saw thousands of new residents each quarter are now struggling to offset even modest outflows. Miami-Dade, for example, posted net migration losses for the first time in years, while Tampa and Orlando saw their annual gains shrink to a trickle. In Lee and Collier counties, where hurricanes and insurance costs hit hardest, the pipeline of out-of-state buyers has all but dried up. The impact goes beyond raw population numbers. Fewer newcomers means fewer household formations, a key driver of housing demand. Historically, about half of net new residents formed independent households within their first year, translating directly into home purchases or rentals. With 250,000 fewer net arrivals, Florida's housing market lost up to 125,000 potential home buyers annually. That shortfall explains why inventory has ballooned, even as the state's overall population continues to inch upward. The buyer deficit also changes the composition of the market. During the boom, deep-pocketed out-of-state buyers set the pace, often willing to pay premiums that local incomes couldn't match. Now, with migration flows at a fraction of their former levels, local buyers, who earn far less on average, are left to fill the gap. The mismatch between available homes and qualified buyers is growing. Demographic data confirms that the slowdown isn't spread evenly. Young professionals and families, especially those in their 20s and 30s, account for the largest share of the missing migration. These were the groups most likely to form new households and drive up demand for starter homes and family-sized properties. Their absence is felt most acutely in the very neighborhoods that filled up fastest during the pandemic boom. Across Florida, the sudden evaporation of buyer demand has shifted the entire housing landscape. The numbers, an 80% migration collapse and a 250,000 person annual deficit, explain why homes now linger on the market, and why sellers face a reality that would have seemed unthinkable just 2 years ago. The housing market in Florida now stands in stark contrast to the feverish days of the migration boom. Inventory has surged past pre-pandemic levels, with MLS data showing more than 172,000 homes listed statewide, a 22.7% increase year over year and the highest count in a decade. The once relentless pace of sales has slowed dramatically. Homes that would have sparked bidding wars in 2022 now linger for weeks, with the average property sitting on the market for 40 to 51 days. This is a 4 to 5-fold increase from the 10-day turnarounds that defined the peak period. At the top of the market, the median Florida home price peaked at $430,000 in April 2024. But that figure masks a growing divide. Price reductions are now routine, and sellers who once expected multiple offers above asking are instead making concessions to attract the shrinking pool of buyers. The shift is visible across property types and regions. According to Florida Realtors and CoreLogic, prices have declined in 66% of single-family home markets and a staggering 92% of condo markets statewide. The condo segment, in particular, faces headwinds from high HOA fees, special assessments, and surging insurance costs, driving many units into extended listing periods and steep markdowns. Regional data highlights the scale of the reversal. In Naples, a market once synonymous with luxury and scarcity, the median sale price has dropped 19.2% from its high, now standing at $767,800. Cape Coral, hard hit by hurricanes and insurance turmoil, has become one of the most distressed markets in the country. Here, 8% of mortgages are underwater, meaning homeowners owe more than their properties are worth. Emergency HOA meetings in March 2025 led to multi-million-dollar special assessments, pushing some owners toward default or forced sales. In St. Petersburg, investor losses have become case studies in the risks of buying at the top. A property purchased for $550,000 in 2022 resold for just $391,000 in 2025, a 28% loss before accounting for transaction costs and interest. The numbers tell a clear story. With 250,000 fewer potential buyers entering the market each year, the balance of power has shifted. Sellers are no longer in control, and buyers, often relying on local incomes, have more leverage to negotiate repairs, closing costs, and price cuts. Inspection and financing contingencies, once routinely waived, are back as standard practice. The days of sight unseen offers and escalation clauses have faded, replaced by a slow, methodical market where homes must compete for attention. The era of easy money and instant sales has ended, leaving behind a landscape shaped by surplus inventory, falling prices, and the sobering reality that Florida's housing market is now governed by local demand, not by the ambitions of out-of-state wealth. Naples, long considered the jewel of Florida's Gulf Coast, found itself at the center of the state's luxury market reversal. In April 2024, the median sale price for a home in Naples stood at $767,800, a figure that would have seemed unthinkable just 2 years earlier. Not because it was high, but because it was nearly 20% lower than the peak. According to Collier County MLS data, prices in Naples fell 19.2% from their high, erasing gains that many believed were permanent. For years, Naples was a magnet for affluent buyers, retirees, executives, and seasonal residents who arrived with cash offers and little concern for local wages or costs. During the migration boom, waterfront properties and gated communities saw bidding wars erupt over listings that might have lingered in quieter times. Real estate agents described a sense of urgency among buyers, many of whom were moving capital out of volatile markets in New York or California. Offers routinely exceeded asking prices, and inspections became optional for those determined not to lose out. By the spring of 2024, the mood had shifted. a Naples homeowner who purchased a newly built home for $950,000 in